If you started looking into investing, you've probably heard the terms ETF and mutual fund thrown around almost like they're the same thing. Many beginners make the assumption that they're completely interchangeable, and honestly, that makes sense on the surface. Both let you pool your money with other investors, both give you instant diversification, both are managed by professionals in many cases. But here's the thing, they're actually quite different in some really important ways, and those differences can genuinely affect your returns, your taxes, and how much money you need to get started. By the end of this video, you'll understand exactly how they work, why they're structured differently, and which one might make more sense for your particular situation. Let's start with the absolute foundation, the core structural difference between these two investment vehicles. Mutual funds have been around since the 1920s, and they operate on a pretty straightforward model. When you buy into a mutual fund, you're purchasing shares in a fund that pools money from thousands or sometimes millions of investors. That pooled money is then invested in stocks, bonds, or other securities according to the fund's strategy. Here's what makes mutual funds unique. They're priced only once per day at the end of the trading day. That price is called the net asset value, or NAV, and it's calculated after the market closes. So if you place an order at 2 in the afternoon, you won't know the exact price you're paying until 4 p.m. when that closing bell rings. This daily pricing mechanism is fundamental to how mutual funds operate. Now let's talk about ETFs, which stands for Exchange Traded Fund. ETFs are the newer invention, really gaining popularity in the last 2 decades. The key difference is right there in the name. They trade on an exchange, just like stocks do. This means you can buy and sell ETF shares throughout the entire trading day, anytime the market is open, and you get real-time pricing. You can buy one share at 9:30 a.m. and sell it at 3 p.m. if you want to. This intraday trading capability is the most visible difference between these two vehicles. ETFs are designed to be traded like stocks, while mutual funds are designed to be buy and hold investments. Now you might be thinking, so what? Why does it matter if I can trade during the day? Well, it actually matters quite a bit for different types of investors and different investing styles. Let's dig into the structural differences a bit more deeply. Most ETFs are passive index funds, meaning they track a specific market index, like the S&P 500 or the total U.S. stock market. They're designed to match the index's performance, not beat it. In contrast, mutual funds come in 2 flavors, actively managed and passively managed. Actively managed mutual funds employ a team of portfolio managers whose job is to research stocks and try to outperform the market. They're making decisions about what to buy and sell based on their analysis. Passively managed mutual funds, on the other hand, simply track an index, just like most ETFs do. So structurally speaking, when you're buying an ETF, you're almost always getting a passive index tracking fund. When you're buying a mutual fund, you might get either active management or passive tracking, depending on which fund you choose. Here's where it gets interesting from a practical standpoint. Because ETFs trade like stocks on an exchange, they use something called the creation and redemption process. When demand for an ETF is high, authorized participants can create new shares and bring them to the market. When demand is low, they can redeem shares and pull them from the market. This keeps the ETF price very close to the actual value of the underlying securities. Mutual funds don't have this mechanism. Instead, mutual fund companies create new shares whenever someone buys into the fund and cancel shares when someone sells. The mutual fund company is essentially the middleman for every transaction. This difference in how shares are created and destroyed actually has cascading effects on how taxes work, how efficiently they track their index, and how they behave in the market. Let's talk about pricing in more practical, real-world terms. With a mutual fund, remember you're stuck with the end-of-day pricing. You submit your order, and you have to wait until the market close to find out what you actually paid. If you're buying during a volatile day, you might be surprised by the final price. You also can't take advantage of intraday price movements. If you have $1,000 to invest and you notice your target fund dipped at lunchtime, you can't act on it immediately. You have to wait until tomorrow. With an ETF, you have full control over the timing. You can place a limit order and say, I want to buy this ETF only if it hits this price, and you'll get filled during the trading day if that price is reached. You can react to market conditions in real time. For passive long-term investors, this doesn't matter much, but for people who like having control and flexibility, ETFs offer something mutual funds simply cannot. The minimum investment amount is another practical difference that matters a lot to beginners. Most mutual funds have account minimums. often ranging from $500 to $3,000, sometimes even higher for institutional share classes. Some mutual fund companies will waive these minimums if you set up automatic monthly contributions, but the requirement still exists. ETFs, on the other hand, have no account minimum. You can buy a single share if you want to. The only limit is the price of one share, which might be anything from $50 to a few $100 depending on the ETF. This makes ETFs much more accessible for new investors with small amounts of money to deploy. If you have $200 to invest, you can absolutely buy an ETF, but you probably can't meet a mutual fund's minimum investment requirement. This is a real advantage for people just starting their investing journey. Now let's get into the tax efficiency difference, because this is where the structural differences actually translate into real dollars and cents in your pocket. Especially actively managed ones tend to generate taxable capital gains distributions throughout the year. When a fund manager sells a security at a profit, that's a capital gain. When the fund distributes those gains to shareholders, you're liable for taxes on them, even if you didn't do anything. You're literally being handed a tax bill for trades that someone else made in the fund. This is one of the biggest hidden costs of mutual fund investing that beginners don't usually understand. You can end up paying taxes on gains you never wanted to realize. It's a subtle but significant disadvantage. ETFs, thanks to their creation and redemption process, are much more tax efficient. When someone wants to sell their ETF shares, that sale happens on the open market between that investor and some other buyer. The ETF itself doesn't have to sell the underlying securities. This means far fewer capital gains are realized inside the fund, and far fewer taxable distributions are made to shareholders. The tax advantage of ETFs can be substantial over decades of investing. Imagine you're comparing two index funds tracking the same index, one is an ETF and one is a mutual fund. They're holding the exact same stocks, but the ETF will likely generate far fewer taxable capital gain distributions. Over 20 or 30 years, this tax efficiency advantage can add up to tens of thousands of dollars, depending on your tax bracket and how much you're investing. This is a massive advantage for ETFs that many beginning investors completely miss. Let's walk through a concrete example to make this tax difference tangible. Let's say you invest $10,000 into a mutual fund tracking the S&P 500 in January. Throughout the year, the fund manager or the automated rebalancing process sells various positions to maintain the fund's strategy. Some of these sales result in capital gains. In December, even though your investment might have only gone up 5%, the fund distributes 10% in taxable capital gains to all shareholders. You didn't create those gains, but you owe taxes on them. If you're in the 22% tax bracket, you just paid $550 in taxes on gains you didn't even realize yet. Your $10,000 is now worth $10,500, but you've lost $550 to taxes. Now compare that to an ETF tracking the exact same index. Due to the creation and redemption mechanism, taxable capital gains distributions are minimal. You might owe taxes only on the gains you actually realized yourself when you eventually sell your shares. This is the silent advantage of ETFs that compounds over your entire investing life. Let's also talk about fees, because costs matter. Most actively managed mutual funds charge expense ratios between 0.5% and 1% or even higher. You're paying for those professional managers to research stocks and make decisions. Many passive mutual funds are cheaper, often charging 0.03 to 0.15%. ETFs, being primarily passive index funds, are incredibly cheap. Many broad market ETFs charge only 0.03 to 0.09% per year. Some charge even less. These seem like small percentages, but they compound. If you invest $100,000 and earn 7% annually, but lose 1% to fees versus 0.1% to fees, that difference adds up to thousands of dollars over 20 years. Fees are an invisible tax on your returns, and ETFs tend to be the most fee-efficient option. Here's something else that surprises beginners. Mutual funds sometimes have loads, which are sales commissions.